The Nifty has been one of the best performing indexes globally in 2022, and the Indian economy probably one of the faster growing economies. Will things look better in 2023? We start our Outlook 2023 series with the brains trust of JP Morgan. Sajid Chinoy, Chief India Economist, and Sanjay Mukim, Strategist Head of India Equity Research at JP Morgan. Gentlemen, thank you very much for your time. Sajid, it did look like the economy's lead indicators were looking good, but this IIP number for October, of course, but minus 4% is thrown a cat among the pigeons. Your estimate for the economy next year?
Morning, Lata. That was a disconcertingly large contraction, but I must admit there was a lot of noise in that data. Okay. Remember, this was the month of Diwali. And so think of this like Chinese New Year, where there are a lot of working day losses in the month of October. And because Diwali falls at different points in different years, year-on-year numbers don't control for that, and standard seasonal adjustment doesn't work. Essentially, therefore, all the October data is going to be weak because there were large losses in working days. It showed up in exports, it showed up in imports, it showed up in IIP. But that should not mask for the more secular trend that we should be bracing for a rotation in growth away from goods, away from industry towards services. Why do I say that? Because we've got to be cognizant of the fact that exports have been a huge driver of India's recovery in the last 12 to 18 months. When we grew at almost 8.7% last fiscal year, 3 percentage points of that was on the back of value addition of exports. And therefore, their contribution to growth was almost double their share in GDP. Now, that was a year in which growth was at 6%. Global growth was at 6%. This year, we think global growth is tracking less than 3%. Next year, even in a more benign scenario where you get some kind of soft landing, global growth will be tracking close to 1.5%. So we have to brace for the fact that the tailwind that exports have given us last year and some part of this year is fading, will fade more next year, and that is going to show up and that's going to weigh on IP data. So IP has been slowing, and you should expect more slowing next year because of exports. The good news is that we're seeing in the last GDP print a rotation towards retail services. The trade, hotels, transport subsector, which for the longest time was below pre-pandemic levels, is now above pre-pandemic levels. So the hope and expectation is that the non-tradable sector will pick up some of the slack, even as some of the tradable sector tailwinds of the last 2 years fade.
Okay. Got that. Well, I'll just come back to you for more economy questions. But Sanjay, welcome. It's tempting to ask you, about the external sector and whether those IT stocks will do badly. But I'll come to that in a bit. Firstly, overall, are earnings likely to be better or worse than this year? We saw, of course, this year much lower than FY22 when we got a huge 40% Nifty EPS growth. How is 23 likely to look, FY24 rather, vis-a-vis the year that's ending?
Morning, Lata. Just a couple of points there that look, on MSCI India, we're looking at about 5% growth for FY23.
Okay.
But that weak number is probably complicated by the huge cuts we've seen in commodity earnings.
Okay.
Now, for FY24, consensus is somewhere around 21%,
okay,
but that appears very aggressive. So I would argue that you will continue to see earnings cuts in India. But if you exclude the commodity parts, I'd say that the banks look insulated from cuts. The earnings growth should relatively come through. But the higher end, growthy, more expensive discretionary companies are the ones where we still think earnings will have to be downgraded.
Okay. Okay. Let me come then to the export argument that Sajid has already extrapolated or explained. Do you think, therefore, IT stocks are not the way to go in 2023?
We don't. We are underweight IT in our model portfolio, and we think that, look, you have this unfortunate situation where the big developed economies are probably heading into recession next year, and this will lead to weaker top-line outcomes. Now, part of that is in consensus. Analysts do have lower earnings or lower top-line growth in their models, but the stocks, some of them at least, are still above historical averages. And more importantly, people have built in margin expansion in FY24, which might be a little bit more challenging to deliver than expected. So I still think that you might get minor earnings revisions, And in any way, you will get a lower tone from management in the coming quarters as the top line slows. So we are not in a rush to buy Indian IT stocks yet.
Yeah, we got a bit of a curtain raiser from HCL Tech, didn't we? In terms of a minor warning. Maybe more will follow. Okay, Sajid, to come back to the economy, what's your sense in terms of the capex cycle? I mean, we spent the better part of this year expecting it. Does it arrive in 2023?
That we'll need to be patient, but recognize what the silver linings are. The silver linings are that this big drag that we've been talking about for 10 years, right, on this twin balance sheet problem has clearly abated. It's clearly alleviated. We've seen significant deleveraging by large corporates over the last 5 years. This was accelerated in the pandemic, such that corporate debt to GDP is now the lowest since 2006. So at least large corporate balance sheets are in much better shape than in recent times. Similarly, bank balance sheets are in much better shape than had been feared at the start of the pandemic. NPAs have been lower for the most part. Banks have recapitalized, and seem to be less risk averse. And you're seeing that in the pickup in credit growth. So the good news is that the balance sheets are in much better shape, and that's a prerequisite to the next capex cycle. But we need to be realistic about the current context, both global and domestic. Utilization rates in manufacturing are ticking up, but they're still at about 76%. And in a world where you worry about, a global recession of some kind next year, where growth is going to slow around the world, in developed markets, in advanced economies, India won't be able to escape that. And at a time where interest rates are at, 2-decade highs around the world, and the Fed is going to remain, high for long, for much of 2023, we have to be realistic that that's not going to be the environment in which entrepreneurs, sitting with utilization below 80, invest aggressively. So the good news is this is going to happen eventually. For the first time, we can see light at the end of the tunnel, but we have to be patient. This may well be a 2024 story, not a 2023 story. One last point, this just makes it more important that public investment continue to do the heavy lifting. We've seen the central government keep pushing on infrastructure spending. States have lagged this year. If you look at the first 7 months, state capex is actually contracted compared to last year. So we need for states to kind of complement the center's efforts here, because that will not only help aggregate demand, it will help raise utilization rates of the private sector such that they get closer to a private investment cycle.
Yeah, I take your point about states, but I think there is more expenditure happening in the second half from anecdotal evidence that we got. And the centre's been at it, though they are the smaller number when it comes to capex spending. We have to depend on the states. Any of the stocks you will like, Sanjay, because of that? I mean, look at the kind of order book L&T told us. It was a mind-boggling highest ever number. Capex candidates, not your pick?
Well, I think capex is a very vast sort of a phrase, Lata, and there are various segments within that as well. And if you were to follow what Sajid is saying, the infrastructure portion should have momentum from a combination of continued central and state government push. We also would argue that capex momentum comes from real estate cycle and real estate activity picking up as well. Because of the total GFCF in India, 30% is simple home construction. And while, yes, there has been a little bit of increase in mortgage rates, we are seeing no evidence of dampening of demand. And in fact, new construction activity seems to be picking up. So rather than focusing on the hope of a corporate revival, I can actually currently see signs of real estate construction picking up. So those are the 2 or 3 pockets within the capex framework: infrastructure driven by whatever the government's doing, and real estate through a natural upcycle are the ones that we'd want to focus on.
So real estate could be in your buy list.
Yes, it is overweight for us.
Okay. Sajid, what about demand continuing? This year we have been complaining a lot about rural demand not picking up. And then this K-shaped economy has kept the upper part, consumer discretionaries, well demanded. How would demand pan out? Will this discretionary demand continue, or is it just revenge buying after COVID and it will peter out? As well, bottom of the pyramid, do you see some life there?
What's been encouraging in the last few months at the bottom of the pyramid is, after a long lacuna, two-wheeler sales have done very well in October and November. Now, we need to be patient because registrations for December have there's been a payback over there, so we have to look at this in its entirety. But the fact that two-wheeler sales are picking up, number one, and number two, that demand for Enrega in the last 6 months has ebbed compared to what it was, are encouraging signs that there is some healing at the bottom of the pyramid. But I think for rural demand and for consumption at the bottom of the pyramid to pick up on a more sustainable basis, you will need kind of more convincing employment creation. Now, the labor market data is more mixed. As I mentioned, Enrega demand has come off. You're seeing that in the surveys, both RBI surveys and PMI surveys, employment perceptions have increased. We're seeing white-collar wage growth be quite strong, at least in nominal terms, among the 4,000 listed companies. So those are all the glass half full. But, if you look at broader other private surveys where employment to population is still kind of flat, and even though rural wages are picking up in nominal terms, in real terms, this is still very tepid. So I think we need to be a little bit careful that there are some signs that the bottom of the pyramid is healing. But we still have some ways to go, and the focus must be on employment generation, because that's the kind of most sustainable way to drive consumption. Let's be realistic, though, that 2023 will be a year where, apart from the export headwinds, policy is going to be normalized. It has been in all emerging markets. Monetary policy was very accommodative for 2 years, and that's helped consumption. But the RBI has correctly had to normalize policy, and we will be moving from a situation where real rates were deeply negative to a situation where real rates are perhaps 1% positive, and that is much needed. Fiscal policy will have to continue consolidating. So domestic demand will be impacted by that policy normalization, and therefore have to be realistic that growth in India, like the rest of the world, is going to see some slowing next year.
Okay.
But to the extent that this slowing corrects some of the imbalances, it corrects the current account deficit, it helps correct core inflation, it will be a necessary kind of course correction.
Okay. Well, actually running out of time, and therefore, Sanjay, how would you therefore be on consumption goods in general? And let me quickly pack the other one. Overall, where would you see the Nifty by end 2023?
Okay, so let me answer the second one first. Lata, we think that, look, the market remains volatile but range-bound again in 2023. So we're seeing base case very minimal returns from an index perspective. This ties in with JP Morgan's global equity view. We've actually argued that the S&P can test the lows of 22 sometime in 23 again, as the volatility drives the markets up and down. So we think the index treads water. Within the consumer pack, as Sajid said, there should be, hopefully over a period of time, a convergence of the K. I would argue, as a result, we are overweight staples, and we are very negative on the expensive non-auto discretionary stocks in India.
Okay, and I would therefore assume a positive on two-wheelers.
Yes.
Okay.
Within the autos, the two-wheelers is a preferred space.
Okay, I'm sorry I'm out of time, but that's a bunch of ideas for people to work with when they start analysing their investments in 2023. Sajid and Sanjay, thank you very much for joining me, and have a great 2023 yourselves.
Pleasure, Lata.
Wrap up on Bazaar. Chartbusters up next.